My name's Ambrose Beanie, and this is my final exam presentation regarding a proposed acquisition of Pilbara Minerals by Wesfarmers. Now, Wesfarmers needs no introduction, but here's one anyway. It is Australia's largest conglomerate with diverse holdings covering retail, chemicals, mining, industrial, and safety products. Profits rose 13% in 2019, and the market is valuing the company at all-time high. However, they are still exposed to a diverse range of risks. Now, how do they manage these risks? Wesfarmers continues to manage these risks by adjusting their portfolio of holdings, pursuing long-term growth opportunities. Lately, Wesfarmers has been aggressive with this strategy, with the frequency of M&A transactions increasing, and as their portfolio adjusts to changing landscapes. So, what risks are Wesfarmers adjusting to? A new threat. Wesfarmers has been proactive to protect itself from the threat of Amazon. They have escaped declining market share and asset-intensive business by divesting from Coles, only to double down on Bunnings and acquire online retailer The Catch Group to support other vulnerable holdings, Kmart and Target. What explains this? Just look stateside. Where grocers Kroger and Walgreens have struggled against Amazon, Home Depot and Lowe's have performed strongly, much like Bunnings will. Wesfarmers has paid attention to this and is committed to a long-term view, and with available capital from the Coles spin-off, we think Wesfarmers shouldn't cool down anytime soon. Similar to retail, disruption in the auto manufacturing market presents opportunities. Level of global car sales has declined for the first time in 2018, however the EV segment is accelerating. Sales up from just 1,000 in 2010 to over 2 million last year. Auto manufacturers have also kept pace, increasing their offerings. Now, we expect the total market to be 56 million EVs by 2040. China will be a major market for EV producers, supported by an aggressive environmental policy aimed to tackle air pollution. Much like Henry Ford's Model T impacted oil demand, we expect Elon Musk's Model 3 to impact lithium demand, as lithium batteries are responsible for 33% of an EV's costs, with some taking on offtake agreements to stabilize their costs. Now, Australia is the largest producer of lithium in the world and has significant advantages over the DRC and Chile, as it is geographically close to these hotspots such as China and Korea. The market is concentrated though, but 4 firms hold 83%. There are many additional small players, however, they are at construction and exploration phases and face challenging investment conditions with declining lithium prices. Revenue, however, is still expected to grow. Now, Pilbara Minerals presents the best acquisition candidate for Wesfarmers. Having aligned its consumer-facing businesses, we think it should do the same with its industrial holdings. Pilbara Minerals is the largest wholly owned lithium miner in Australia. It's yet to make a profit, however, it has all the building blocks to do so. Pilbara has taken a long-term view by securing a series of offtake agreements with the Great Wall Motor Company, South Korean lithium processor POSCO. These agreements provide Pilbara Minerals with stable long-term revenues, assists forecasting for more efficient capital expenditure, and allows them to directly feed into the Chinese EV value chain. Sitting at the heart is Pilgangaroo, its sole revenue-generating project, a hard rock mine geographically located close to Port Hedland. It's currently under a series of stages of expansions and is currently operating at 95% capacity with a current recovery rate of 65%. Now, when valuing Pilbara Minerals, we utilize the net asset value approach due to the expected mine life of Pilgangaroo coming to an end in 2039. Our model was split in 3 stages to replicate each capacity change. We derived a value of $641 million from this valuation. Now, Wesfarmers is absent from the lithium market, so there'll be no revenue synergies. However, we do expect great cost synergies as it is able to collectively negotiate, leveraging its existing mining holdings to lower costs. We believe an annual average cost saving of 14% to be made. Now, we took a conservative view when it came to the pricing of spodumene concentrate at $633 US per dry metric ton. The market has rejected volatile prices as the value chain has entered into long-term contracts at a discount to the spot rate. Continuation of these practices was assumed. The discount rate used was Pilbara Minerals' own weighted average cost of capital, as this accounted for the unique risks posed with the Pilgangaroo project. With a standalone valuation factoring in the cost synergies, our upper valuation band sits at $1.14 billion. When it came to utilizing a relative valuation approach, it was difficult because of the NAV approach used, capturing unique mining risks. Further to this, the whole diverse range of firm maturity and firm size also made a relative analysis difficult. We arrived at 533 million. Now, to structure the deal, we recommend an all-cash scheme of agreement. We also recommend the structure of a reverse triangular merger to assist with future adjustments to the portfolio. Wesfarmers is to finance the deal via debt, as it did not replace a $500 million debt which matured last year. Now, the scheme of agreement will need to be ruled upon by FC from the Federal Court of Australia after approval from ASIC and the ASX. It will not be subject to a foreign review board, and the Australian government is likely to support it as it supports its critical mineral strategy. The CEO has not ruled out being open to an acquisition or selling equity stakes in the project. Given the recent share performance and negative short-term outlook, we accept Pilbara Minerals to get on board with this proposal. We also expect a warm reception from Wesfarmers stakeholders. To recap, we believe in proceeding with the acquisition. There's an expected 27% return if the target price is achieved. The acquisition fits Wesfarmers' long-term view as it aligns the portfolio for a growth industry.